Hello everyone, this is Ted Bauman here with your weekly Friday Bauman Daily video. If you'd like to subscribe to my newsletter, the Bauman Letter, or to any of my other services, click on the link up here above my left shoulder. I'm not going to play a guitar today because the one I was going to play needs some wiring work. I'll play it next week. It's the last one of my collection. This week I want to talk about investing styles and investing strategies, and this is prompted by a comment that somebody made on one of my recent videos where frankly this person completely misconstrued the nature of my investing strategy with the Bauman Letter, the way I approach investing, but nevertheless the person did opine that a buy and hold strategy was the only way to make money in the stock market. I've heard that before, and I have a lot of sympathy for it. In fact, we do a lot of buying and holding in the Bauman Letter, but unfortunately it's not suited to all situations or to all investing strategies, and this week I want to demonstrate exactly why that's the case. Let's start with a chart that shows the relative performance of a number of different stock indices over the last 20 years or so. As you can see at the very top in the recent performance is the Nasdaq. You can also see they're clustered in the right hand side are all the US indices, the Dow, this S&P 500, as well as the German DAX, which has done relatively well over the last 20 years or so. You can see at the bottom, unfortunately, our cousins across the pond, the UK and the Japanese, not doing so well. Now, the interesting thing about this chart is that it has not always been like this. You can see that back in the 2000s, the Nasdaq technology sector was at the very bottom. In fact, the very top tended to be the Dow or the German index. Generally speaking, the Nasdaq did not become the premier performer really until a couple of years ago, the beginning of 2018. And even then, we can see a couple of major dips in that index ever since then. We've had, quite frankly, a lot of volatility in the last couple of years. Now, the reason I show this is just to show that the way things are right now is not necessarily the way things will always be. Things change over time. Now, let me show you why it's important sometimes to be ready to make a switch. This next chart shows the performance of a pick that we made for my Alpha Stock Alert service at the beginning of June. It's a company that was really going along reasonably closely to the S&P 500 up until then, and then it took off like a rocket. Right now it is up by over 215% since we bought it. Now, the reason I flash that up there is simply to illustrate that even if you're involved in a buy and hold strategy, if you spot an opportunity like this where you can make over 200% in less than 2 months, you need to do it. You need to basically try to find out as much as you can about the company, its prospects, and also whether it has wind in its sails, whether it has momentum. Now, let's talk about the kinds of factor strategies that one might play in the stock market. This chart shows the relative performance of different clusters of stocks over the last 2 decades. The purple line is momentum stocks, stocks that tend to have rising share prices. They're really defined by the fact that people are buying more and more of them, and their share prices are rising over time. The brown line is value stocks. They're stocks that people buy because the stocks are undervalued relative to their intrinsic value and their earning potential. The green line, which is relatively recent tracking, shows companies that have strong balance sheets and strong return on equity. Now, the point of showing this is simply that this relationship between these different types of factor strategies changes over time. Periodically, momentum stocks are the best performing stocks in the market, but then they aren't. We can see they fell dramatically in the beginning of the 2000s. They fell dramatically during the Great Financial Crisis. And the interesting thing is that after the Great Financial Crisis, they took a long time to recover. We didn't really start seeing sustainable upward movement in the momentum stocks, at least outstripping value stocks, until really the beginning of this year. What's interesting also is that you see that quality stocks at the beginning of this year, when the crisis hit, rocketed upwards in terms of the relative performance. Now, the interesting thing about all of this, again, like the previous chart, is that it shows that the kinds of strategies that have worked over a period of time often stop working, and they reward, different strategies reward investors. And particularly, I think it's interesting to see that overall, over the last decade, it's been value stocks that have returned reasonably well compared to momentum stocks Although, if you start both at a zero starting point, it appears that momentum stocks have performed better. It's not always the case, and I think that's really the critical thing to pay attention to here. Now, the reason why I'm raising this is because we could be on the cusp of another change, whether it's a short-term change for a month or two or a longer-term change for 3 months or so, hard to say. We did see a change like this at the beginning of 2019, and I saw stocks in my Alpha Stock Alert portfolio, for example, which tend to have a lot of momentum and growth stocks in them. They tended to do very poorly during that early period of 2019 when we went through a momentum shift. They did bounce back, but it did teach me a lesson about how these factors can shift. Now, here's a chart that shows 3 major asset classes that have recently seen declines in value. One is the Treasury bonds. You can see from the TLT ETF down very significantly over the last couple of trading sessions. Same with gold, same with Chinese large caps. Now, the Chinese large caps obviously have a different set of factors behind them, particularly the problems with the political relationship between China and the United States. But what we see here is a pattern where assets that people have held for a while and have gained on are now being liquidated. Now, why would you liquidate them? Well, there's a couple different reasons. One is because maybe you think that their prices are going to fall, and everybody decides at the same time that they've got that prediction right, and they sell. Another reason could be that people are trying to raise cash to move into a different category of stocks that is starting to exhibit stronger potential forward returns. Now, here's the second part of that chart that comes from the Investors Business Daily newsletter, and it shows where that money went. It went into consumer staples, it went into healthcare stocks, and it went back into technology, the broad technology sector, not just the very top, not just the Nasdaq, but technology as a broader category. Now, the reason why I raise this is basically to ask, why is that the case? Why would we have seen people liquidating stores of value like bonds and gold and potentially other asset classes in order to put money into these really low-flying, everyday categories of assets? Well, one reason might be that the perceived future rate of change of those particular assets is going to be greater over the next few months, possibly longer, than those existing categories of assets. Now, if an investor spots an opportunity, one of the things he or she wants to do is to generate cash to take advantage of it. That could be why people are selling bonds and selling gold, because they want to buy stocks that are perceived to have, again, a greater possibility of a higher upward rate of change than the existing pattern of investments in a person's portfolio. Now, here's a chart that shows a number of sort of ordinary everyday sectors relative to the S&P 500. Since the beginning of this year, as you can see, there's only really a couple of categories that have outperformed the S&P. One is technology, top green line. The next one is consumer discretionary, and that's a little surprising. But the reason is, I think, because people have been buying up cell phones and tablets and computers and all kinds of other things to try to cope with the fact that they need to work and operate remotely. But as you can see, there are a number of other sectors, transports in red, industrials in light green, retail and utilities, which have also underperformed, but seem to have picked up a little bit of steam recently. So let's look at a more recent chart for that one. This is the last 4 weeks. As you can see, utilities really are the loser, but everybody else is outperforming the S&P. Particularly, we see transports making pretty good gains, particularly during August. But look at, basically the industrials and those kinds of stocks. They are starting to pick up some real momentum. We're starting to see consumer discretionary and retail in particular, that top line, starting to pick up steam. That's amplified by this chart that shows the last 5 days trading sessions. I'm recording this on a Thursday. You can see at the very top we have transports and industrials. Technology is actually at the very bottom. Now, the reason why I point all this out is simply to say 2 things. One, yes, buy and hold is a great strategy, but it's not the only one, and it's not always the most appropriate one, particularly if your time horizons are not 20 years or so. If you're just starting as an investor and you're piling up money into your 401k or an IRA or just an ordinary brokerage account, absolutely. You should probably just concentrate on buying good value stocks with growth potential and hang on to them. Don't mess around with them too much. But if you're like a lot of the readers of the Bauman letter, who are people who are trying to make money really to compensate for years and years of poor income, many working people, as I showed in my video last week, have been penalized severely by the structure of our economy over the last decade or so, even longer. And also people who simply have not been able to accumulate enough retirement savings. Those kind of people are looking for opportunities for short-term income boosts. And that's precisely why my Bauman letter is divided into three categories. One is oriented towards income and dividends. One is oriented towards a longer-term buy and hold stock price appreciation strategy. And the last one is what we call the home runs portfolio, which is designed to try to capture short-term gain. And that has also had an important role to play in the Bauman letter strategy. We just sold a position we'd held for 6 months for an 85% gain. That just goes to show that there are not simply one way to make money off of stocks. And depending on your approach, sometimes it's important to try to adapt and adopt these other approaches as well. Now, I say that partly because I know a lot of people took my sort of recommendation earlier this year to be wary of the possibility of a dip in the stock market this year as an indication not to buy stocks at all. I'm sorry if you interpreted it that way, but essentially what I was saying is for the stocks that you want to buy, look out, they may end up coming through cheaper later on. Now, that has actually happened for a lot of categories of stocks. On the other hand, a lot of stocks that people bought earlier this year that had a big bump in price have actually not sustained those bumps. They have gone up and then gone back down again. That includes things like airlines, cruise ships, and to a certain extent, some of the other specific companies, things like the bankrupt companies and Hertz and all that sort of stuff. Never mind. The point is, you don't win all the time, but it's nothing wrong with pursuing a momentum strategy. The point is that you cannot rely on any one strategy persisting over time. I've just proved to you with the charts that different factors and different sectors of the economy perform differently at different times. Different factors like momentum, quality, value, etc. also perform differently over time. Now, we may be heading into a rotation period in which I believe value stocks are going to exhibit some of the characteristics of momentum stocks, in that because they're beaten down so far by COVID, people will begin to buy them and they'll begin to chase them upwards in price because they see their price going up. That's the classic definition of a momentum trade. You buy it because you see its price going up, you see the relative strength index going up, you see MACD going up, you see all the oscillators telling you that the market likes this stock, so you buy it. Now, that's a good strategy, but I think it's the kind of strategy that one has to segment away from your buy and hold strategy, which is exactly what we do in the Bauman letter. So just to dispel that misconception, that's the way we do things at the Bauman letter. Finally, I want to thank everybody who sends in positive comments. We don't always get positive comments, but when we do, they are very positive, and I thank you very much. I do read them all and take care for a lot of them. Anyway, this is me, Ted Bauman, signing off. I'll talk to you again next week.